Crediwatch and Confederation of Indian Industry invite you to join Redefining Credit Risk Monitoring to steer through certain times. In this webinar today, we will cover the importance of credit monitoring, roadblocks, and traditional monitoring tools, the need of a near real-time risk monitoring solution addressing regulatory expectations, why you should look at alternative data, technology enablers for building a robust EWS, benefits of an AI/ML based EWS. To take us through this journey and to give us more insights around the subject, I would like to invite two very well known experts from the industry, that is Mr. Ramaswamy Meyappan, he is Chief Risk Officer in IndusInd Bank, and Mr. Hemanth GC, Head of Product from Crediwatch, who will conduct the webinar today. Mr. Ramaswamy Meyappan is Chief Risk Officer from IndusInd Bank, and he knows it better on how one can build an effective credit risk monitoring framework. Mr. Meyappan will share his rich experience with the span of 26 years in the risk management solutions. Once again, welcome to the Industry Insight series, a webinar-based knowledge and networking service for and by the industry. Over to Mr. Ramaswamy and Mr. Hemanth, please. Thank you.
Thank you.
Yeah, thank you, Abhishek, and welcome to all of you to this fireside chat. We will get started with sort of question that is on everybody's mind currently, right? Mr. Ramaswamy, I think no better way than kind of get started with a little bit about your thoughts, your opinions, your viewpoint, given the current context, right, around COVID and the kind of challenges that all businesses are today facing, right? And even more so when it comes to banks and financial institutions themselves. In kind of how are you preparing for this situation? We're all aware of the moratoriums, the loan recast options itself, the stimulus package that the government is kind of handing out, and all of this is sort of very new, right? None of us was really prepared for this kind of a situation. I think that's a good starting point, because many from the audience have even kind of reached out asking for your thoughts and opinions on how do you as an individual and how do banks as a system kind of deal with this, right? Any thoughts there, Ram, on that?
Thanks, Hemanth. So thanks everyone who's on the webinar. So yeah, it's been a very challenging time, I think, since March, when the lockdowns were announced, and getting used to working on a very different way, where you are used to meeting people, you're used to meeting clients. And now when I recently met a client, I forgot to then give a visiting card because you don't know where you kept it. For the last 7-8 months, you didn't have a need for it. You were only in front of video calls and others. So it's been a very different environment, trying to work, connect with people. We've, for example, for 5 years, have done audio calls, and now we do all our credit committees on video calls. It's just changed because of COVID, right? So we've got our technology up, our bandwidth up. We're working in a far more seamless manner. People are able to work from different locations, and we still were able to close an annual financial inspection with their RBI, with the statutory auditors, 3 quarters of results, all without physically meeting anybody. It was all done electronically. So it's a very big change. It's made us rethink the way we work, rethink about, do we need everybody in the office? Do you want, can you work offline? How do you give people connectivity? It's a lot of things has been what we took for granted has been given us a chance to relook at doing things better. And I think using technology is one of those aspects. And something that we're going to talk about today about monitoring it, the need of presence to be there. Now you can do a client call through video, which you could have always done, but earlier we used to travel out, meet a client. Now you're able to do it. You're able to do a conference call with many clients. So a lot of things have changed, maybe for the better. We've got made us to rethink the ways we've been doing things. So it has been quite challenging, no doubt. I think continuous flow of regulatory requirements, continuous requirements to ensure our digital infrastructure doesn't let us down, security thing. CISO teams are on top of the job. We don't have challenges. Connectivity being given for multiple people to access systems, to monitor the different people are online, about monitoring their attendance or their performance, how many logged in, not out. So different parts of the bank had to look at all the technical infrastructure to get things done. And it's been slowly we're back. Maybe 30, 40, 50% of people are back at work, but still, maybe on a permanent basis, we may see a few people work from home on a rostering basis. So that's a big change we've seen. We've also learned to do a lot of stuff differently, and it's possible to do it technologically and use your mails and others more effective than having to have physical meetings. Many meetings have become more focused because you have only that half an hour now, but there are too many meetings, I think, which I'm sure most people appreciate. There are too many meetings these days.
Yeah, kind of agree more on that. So two kind of key points that you brought up, and maybe we can spend a few minutes digging a little deeper into those specifically, right? One is around the use of technology, and this is sort of coming to the fore right now in all aspects, largely around communication, sort of working remote, etc. Right? And your thoughts on, you see this kind of continuing and this becomes the new norm itself, right? And second, as an extension of that, because people are kind of generally more open to using technology, more open to using newer ways of communicating with each other, you also kind of see that rubbing off into traditional ways that people did business, right? And especially when it comes to the banking space itself, and how you reach out to customers, or the field visits that were kind of mandated. You see use of technology kind of changing all of that in the banking sector itself.
Yes, a lot of it is being thought through. For example, I may use an example of internal audit or of branches, which used to happen where physically the internal auditors had to go branches. Now we are talking a lot about digital way of looking at using the cameras, looking at login at the cash counters, etc. Because you're not able to travel into remote parts. So using technology from internal audit, I've heard my internal audit team talking about how they can use that technology, which looking at the cash counting, etc., and monitoring it from a head office level. I think HR teams are looking at technology to use when people are working from home, about the login, the kind of times we were, for example, our HR team looked at how many people had not logged in at all during this period. So, because you have your ways of looking at your use of the IP addresses and others. So different parts of the bank have started thinking on use of technology, digital banking, digital KYC, a big difference which has made. We launched a digital KYC. We open accounts, we just sit in front of the camera, photograph is taken, you get it done. That's a big difference than physical, going across. You show your Aadhaar card in front and an image is captured and immediately recorded, accounts are opened. So that's changed on the retail side. Clearly, because of the payments infrastructure has improved considerably now, because you make sure that your clients get all kinds of digital payment options so they don't have to physically come to the branch. Actually, some banks discourage branch visits, right, by charging you more because you want better productivity. And, there are so many ways that technology has made a change. And I think it's expedited due to the COVID situation, that you're now talking more about productivity, how you can use technology, how you can extract data quickly, how you can get the data ahead of somebody else or use different sources. So I think a lot of time we're spending today on how to capture the data. For example, in your cloud function, your data mart, as you call it, how do you map all the data? How can you source data? Because the kind of queries you're getting from your regulator, from customers or different cards are very different today. So the regulation in the past, a regulator used to come in once a year, had a standard set of questions. Today, it's an ongoing monitoring. If they see for example, gold prices have spiked, let's assume, and then they will ask you, what's your gold loan portfolio? What is this cut? Which concentration? You need to be able to capture the data and respond back in a very short time. And unless you have mapped all of that, and our technology can pull the data out. Where, for example, we used to overwrite a lot of data on review. Now today, the regulator wants a track record of how many reviews were done in the last 4 years, let's assume. So then now we have changed our technology space now not to overwrite the data. So learning every day, it's challenging. When we have a retail and a wholesale bank, there are different approaches. You find retail adopt very fast to the technology space because that's why they grow. There's a lot of digital lending. Wholesale is a bit different. So a lot of time I spend is on the risk data to capture, working with external consultants internally all the time, asking questions on how this could be done better. We don't repeat tasks. How can we pull the data out? Like for example, we get an email ID for a client to make a margin call. We noticed that we were entering it a couple of times in different systems, which would do different teams. Now we said it's possible to just pull it off, pull off. It may sound very simple, but in a banking system, it's not like when a new entity starts, they start differently. We need to catch up, and we're doing a lot of that stuff these days. So spending a lot of time on a risk data mart, on the cloud-based data capture, a lot of that stuff. So technology is becoming a major part of the way we do it. And use of technology for credit analysis, I'm going to talk about, I'm sure, when you have that query.
So, I think from a context for the webinar itself, right, the kind of importance of credit monitoring, I don't think there's a better time to discuss this, right? Given the way that we're all dealing with the COVID situation itself, and the fact that how regulators, policies, banks policies, government schemes, etc. All of these are sort of in a state of flux, right? And to be able to stay on top of this, it really does require sort of an active monitoring strategy in addition to a policy itself, right?
Yeah.
And so, in your view, how has credit monitoring kind of changed over the years, right? And given the kind of experience that you have in the domain and in the space, even without COVID, I'm sure you would have seen the entire credit monitoring space kind of evolve over the years, right? And if you could share some insights and experiences on how you have seen credit monitoring itself change over these years. Of course, backed with a lot of technology and backed with capabilities that exist today that didn't exist in the past. Maybe a couple of insights and instances that you could share with us as well on how you've seen this evolve.
Sure. So, I mean, when I started early up in banking, I think a lot depended purely on manual and information that you gathered. Relationship managers. I mean, if you had to do a summation of your debits and credits, there was no, you don't use technology, you didn't read, statements couldn't be read, you entered them, today you have to, various agencies can read your bank statements, give you a summation of your debits and credits. You have access to technology to look at the GST returns. You have access to technology to look at your TDS deductions. You have legal databases where you look at what are the court matters which are pending, or a lot of that in the past was based on what you gathered while meeting a client, and you relied on that data. Today, the way it's changed is, for example, stock statement analysis earlier was very manual. It took a longer time to reach RM or the credit analyst. Today, when a stock statement comes, we are able to scan it, we are able to analyze it. There are queries which are set under artificial intelligence and machine learning kind of techniques, where if there is a 20% reduction in the debtors or creditors, automatically a flag, and we send an alert out to the RM and the credit. I mean, that's where we're going towards, we're working on it. But those are the kind of things which helps us to be able to react faster. So using technology, we have platforms like database platforms, like if I may use an example name like Save Risk is one of them. You can get a lot of data on the charges which are actively open. You get databases where you can look at charges which others have filed, where the borrowing levels are. And then you have RBI's own database on CRILC and others, where it gives you a lot more insights into other corporates. So using all of this efficiently by pulling data using APIs or whatever, getting the alerts, and that's what flows into what the early warning system and stuff. One, it helps you credit monitor. Other, the early warning helps you to identify issues much ahead of time so that you can react faster, because information is available to everybody at the same time. Sometimes you have to be quicker to capture that if you have to react and get yourself in a better secured position. So it's no longer that information of PLC is not available to X or Y. Every bank has that access. So everybody knows where the issues are. So keeping up with technology is becoming very critical. Also, COVID, I must say, has made a cost cutting as a major issue to keep yourself efficient, which means you are forced to use more of technology and monitoring, remote tools and location tools. Technologies have become a major requirement for us to be able to react quickly. And for that, there are different tools. I mean, it's challenging as a risk guy to understand. So I'm relying a lot on my IT and solution delivery group and others, because we have ideas, but you don't know how to convert them. I hear a lot of them now, but clearly the ways of doing business have changed. Your reaction times are lesser, and there's a lot more that you can do. Your surrogate kind of data is available. You can look at PF data in case somebody stopped paying PF. You get an alert knowing that there is a problem there. You can look at GST data on how many locations they are in. Recently, if you want to use this technology, an example, I can use one example. There was a credit which I received of a particular EPC company located in one particular state, operating in one particular type of customer, a government agency. Did not like the credit very much, so I went back with some issues. But when you look at the GST data and the TDS data month on month, you can clearly see that the turnover is justified by what they've done. It was not possible in the past. You had to send an auditor to inspect. Today, you're able to validate against a government filed report. So that's a big change, and because of which I changed my view, we took a decision. It could go on the other way also if you could not match it. So today we have built in such warning systems, early warning systems into our track record. Looking at your filings in the triggers are there. There are a lot of companies which can give you data. So it helps a lot using the right. There's an overdose of information. You have to decide which is the right one for you, what works well, because you could get a lot of false alerts also. So you need to just make sure you have the right. You define the problem, you define what you want very well, and get the right solution. It's critical to do that so that you don't end up with an overload of information, and because of which again you miss the the trees or the forest.
Sure. So I think there are two audience questions that have come in, and I think pertinent to kind of pick that up right now. One, of course, is again from the COVID context. The question is, how are you dealing with data of defaulters who are affected by COVID, and how do you kind of use that data, and what's your treatment itself there?
One of the biggest challenges of the data on COVID time, we had all data till February 29th. Then all the reporting got suspended during the moratorium period. Even your rating agencies today don't have data fully. I think you will get all of that data hopefully when the Supreme Court decides to lift the classification norm. They put a stage way on the non-performing. Since the hearing we thought will decide yesterday is now moved to the 8th of December. So we would get a lot of that data and more validated data, and how much of those customers are paying to us, not paying to others, or paying to others, not paying to us. All of the data I think will only get much more distilled and clearer in Q4 of financial year, which is January to March. Today, that data is not giving us the insights that we would have usually should have got. So we are relying more on our internal information and the queries that we ask. But to get that commercial credit data, commercial CIBIL and individual CIBIL data or other credit rating agency data, I think will only come in by the Q4, because they've also had their challenge. Because we are not reporting non-performing assets, we cannot. We are contempt of court, so we really don't have the full data. But maybe that will get resolved. But once the data comes in, a lot of work will go into it to rewrite of some of our policies. Already we have tightened our underwriting policies on retail, looking at how the moratorium played out and which pocket of customers gave us more trouble. We will further tighten it up or relax depending upon what the data shows. So is it a particular type of people in salary class who got impacted, or we know we have some indication of that, but you'll need a much larger database, but we may not have such a wide database as some of our larger peer banks have. So once that data comes in, we'll be able to call out to see the performance of different rating CIBIL ratings and others to help us fine tune our policies. Today, it's been tightened based on our own experience. A lot of collection data has gone into tightening up our databases.
True. In fact, one of the questions that we get asked as well, right, in terms of capabilities from a monitoring or even an analytics perspective, is we're all used to the traditional bank statement analysis and the power that analyzing a bank statement can get into your decision-making process itself. But in terms of how technology companies are keeping up to date with the situation itself, right? When we look at a bank statement today, we are trying to not just identify whether there's an EMI that's due on the account. Is there a regular EMI schedule itself reflecting on the bank statement? But from a moratorium perspective, is he taking it up? Is he not making those EMI payments? Has he deferred some of that payment itself? Right? And we are also kind of adopting this change in the way that we look at not the bank statement itself and the insights that we can now sort of offer to either a credit officer or even a risk member of the risk team in terms of highlighting some of these data points. Right. One of the things that you did mention, how things have changed over the past. Earlier, a lot of the relationship manager or the branch level manager would kind of know the customer, especially if it's a small commercial setup. They would kind of know the promoter, they would know the person running the business, and a lot of the credit decision itself would kind of be relationship driven and relationship based, right? I know, Ramu, we were chatting earlier, and you did mention your interest in the popular series House of Cards, right? And there is a quote in that that says, "Friends make the worst enemies." So these traditional kind of credit analysis or credit decisions were majorly driven by relationships, right? So you knew the promoter, you knew his business, even though he's not doesn't have a cash flow to manage the next 2 months, you kind of still take a decision to go ahead with him and allow him that leeway. Today, banks are kind of moving a lot of this decisioning itself to central offices, right? You've got central teams taking decisions on credit, which now means that the last leg of information that you had about the end customer, that is in a way out of the picture, right? So you're kind of taking pure data-driven decisions, monitoring is purely based on what the data tells you. So how do you see this dichotomy, right? That on the one hand, kind of saying decisions are central, decisions are data-driven, and the relationship that these branch managers or the last mile team members had about the customer. How do you sort of loop that in and use that into your monitoring itself today?
So the approach is quite different. As you said, central where it comes to digital lending today, you're right. I mean, that part of it is pure data driven. So you look at, there is, I think many of these firms have mastered the art of reading what the codes are in each bank statement or which each entity is to pick up. And so that's a straight through digital lending, which is done to retail personal loans and approving a credit card and etc. And, we want to reach a certain percentage where then the traditional risk person who was doing all of that is now become more of a monitoring kind of thing, saying, is there an issue and do I need to fine tune the model rather than having to approve every application? So there, I think absolutely the relationship part is gone because you're doing it online, you don't even go to the branch. But in corporate lending, mid-market lending, I still the relationship angle is quite critical. But what today we are doing is a mix and match. You have the relationship, you meet the client. It's an absolute necessity if you do an agri loan where you are expected to take a photograph in front of the property and send it to you. Your GPS is marked so you know which site. So using technology to identify that there really is a property there, and you have that record with you. I think the person when they go and do a tab from there and take a photograph, you are able to track the GPS location to know that they have visited that location, which we do for our microfinance also, where when our microfinance RM's relationship team goes out, we track them to GPS and we know how many kilometers they did, which village they visited, what they did. So it's a mix and match of both. So certain straight through retail products today there is no human touch to it. It's on a model. A model. Look at it for the lending in a corporate side, on a mid-market side, still the relationship point is there, but you're able to revalidate a lot of data that a RM or gets from the client through in other sources. So GST is one of them, or tax returns is one of them. Tax returns is always there, but you can look at the TDS. There are various other ways that you can validate the data. So how do you optimally use technology to validate data? I mean, if you want, you can check the power usage to know if the factory has been running. If you really have that data and you can access that data, which some countries do in a very effective way because power is a critical element. PF is a critical element to know how many employees are there. So but the relationship part cannot be taken away from the corporate kind of lending, visiting a site. So it's traditional change. Technology is used to top up in some cases, and in some cases it's gone a pure technology way where the risk function has become more of fine-tuning the model and monitoring it rather than approving each application. So that may be good for retail products, but a car loan could be done that way. But for a mid-market client where you're going to go LCs guarantees, you may want to visit the site. You'll have it inbuilt into your performance, and you will be able to track your RM was there through technology because they'll use their tab or whatever to send you the data. So it's use of technology, but in different forms. And total technology, and some is using technology to validate what you would have taken for granted earlier.
Right. So I think the other important point that you kind of mentioned is the availability. One, and second, of course, is the use of alternative data. Right. You did mention about power usage or even EPFO data, etc. Right. So one of the things that even at Crediwatch and the kind of monitoring solution systems that we use and that we deploy, one of the areas that we also focus on is on alternative data and how we can kind of leverage that, especially in the case where, the thin file clients where you might not have necessarily access to the traditional ways of evaluating them, right? It's a small proprietary kind of a setup. His financials are, not all that promising or not all that great, but can you use alternative data there to kind of evaluate him in better light, right? And I think now, given the sort of data proliferation that's happening, given the kind of data that we're today looking at, whether it's from POS systems or ERP systems, or even from GST, EPFO, it could be even UPI in a lot of cases. The sheer volume of data that we are now sort of generating and we have access to, and if you marry that with kind of analytical capabilities that are again sort of enabled because of cloud infrastructure, the ability to kind of put to use very high CPU, high compute intensive processes using cloud infrastructure. I think alternative data is going to become sort of crucial in being able to evaluate a lot of these cases, right? And again, one of the things that one of the quotes that come to mind again from the House of Cards series is there's no better way to overpower a trickle of tau than with a flood of naked truth, right? And alternative data is sort of the naked truth, right? It kind of puts it in your face. It tells you, more that you want to know about the business, about the corporate, about the health of the company itself, right? People, in fact, are even sort of connecting a lot of these businesses through IoT itself, right? To kind of generate data by the second if required, right? And we know of cases where a typical dairy farm setup is kind of using IoT to be able to track the extent of milk that is kind of getting produced hour by hour as well, right? And all of that kind of feeds back into backend systems where you're now able to take a look at a lot more data and decide a lot better in terms of either credit worthiness or health of the business. A lot of the financial data points that typically get considered for either credit decisioning or even monitoring, right? We're sort of used to looking at data quarterly or for private companies even annually, right? But a lot of this flow-based data that's today sort of emerging, that adds a lot of power to the analysis itself, right? Just want to hear your thoughts on, have you seen this getting used in real time, in real business use cases? Or do you think it's still some time away before it becomes mainstream use itself of alternate data?
There is, as I said, banks are the last to adopt. It takes a long time to adopt. I think there is also a mindset change here. You're used to a particular way and it takes time to change. But, for example, there was one person who came and met us who said, I can use drones to do your site visit. You don't need to go there. I will fly the drone over and show you the entire length. And he showed me the Delhi-Agra road with every bridge and the construction that had happened. Sounds a very interesting proposition. Similarly, we could do remote verification of our solar sites. He showed me a site where the solar construction, and they were able to map and say they're behind on the schedule. Because by now, if they mapped it, measured it, and said he's at 63% when they should have been at 75%. So construction is low. So sitting in my office, I will be able to do that. Because there is technology that's available to do that. So we will have to adopt. It will take us some time, but we will get there. We can do a warehouse, for example. We do remote locations where warehouses are there with stock. We can actually have them verified, without having physically to go there using technology. So these are things that we will adopt over a period of time. It's not yet so widely adopted, but there are a lot of ideas coming up, and I think it will get adopted. It takes some time for banks to change from the traditional ways to doing all of this. I think it's like, I think vehicle finance has GPS, so locators are possible. US use it and many other countries. You can seize the vehicle by shutting off the engine. So some people have done it. The GPS locations are there, where the trucks are, which are financed. So technology adoption is happening, but it's happening slow pace, but it will happen. I think it will pick up pace as you have a higher value assets, you want to be sure on top of things. That's how the adoption will happen. And when there is a wide adoption across the banking system, so that will be critical because there is a cost factor to all of this. So if you have a consortium lender, they need to adopt it. Only you alone cannot be able to do that. So there are different ways of doing it. I agree with you, but it will take some more time before we want to do it on a daily monitoring basis. That cannot happen. But you're right, going away from half-yearly annual to half-yearly to quarterly, now with a early warning system, and from just looking at a Google alert, which is you set up for a company that used to monitor. Today, you can get alerts on your phone whenever you're thinking on any news that happens, based on what, for example, Crediwatch has worked with us, so you will give us alerts, and we'll identify what those alerts are and react today, then react when the next annual review happens. So that is a big difference. So some of it will rely on other sources, but as a bank to take it up, it depends on the critical mass and the volume before we do it. So maybe we adopted a GPS kind of thing more in our vehicle finance because we have a large portfolio. Project finance, we may adopt the drone kind of thing as we do more projects, because you don't have to send somebody out and every 3 months you can have that checked. The cost depends on the cost.
Right. So there is also this point about information asymmetry that you mentioned some time back, right? Essentially, like late knowledge about an event is as good as not having knowledge at all, right? So in the context of handling this information asymmetry, in sort of being able to stay on top of things, the need for this real-time monitoring is even more now than ever before, right? Because you always want to stay on top of what is the information curve in terms of knowing as much there is to know about your customer as early as you can, right? And I think there was an Unlock BFSI webinar a couple of months back where a lot of the banks kind of indicated that that there is a growing confidence in terms of being able to use technology, being able to deploy technology for credit decisioning and even credit monitoring, right? But the biggest hesitation that all of them, or most of them, kind of highlighted was the ability to deal with this asymmetry of information itself, right? And that I think becomes a crucial gap to bridge, before banks can sort of go all out again on lending, monitoring, and sort of improving the overall health of the credit ecosystem itself, right? And I think by all estimates, the credit gap that exists today is as much as 380 billion in the Indian market, right? A large percentage of that gap or demand itself is from the SMEs, right? The smaller companies, either private limited or proprietorships and partnerships, right? What's your view there on, how do you see the space itself evolve? And given the MSME segment is such a huge segment in the country today, what different is, for example, IndusInd kind of trying to do there in bridging that gap that exists on credit terms?
So yeah, I think quality of the data that you get from MSME or the type of partnership and others is always a challenge. So you need to have alternate. That's what I said. You may not be able to rely on the financial statement because they're not audited or whatever. So there you have to look at data, how much came from my bank account. So you adopt a different type of underwriting policy there, where the dependence on a financial is lesser. It's more dependent on how much came to the bank account. Did we capture all the cash flows? Are they GST registered? Are they paying their salaries on time? Whatever. Different ways of looking at it. So the underwriting policies will only make a difference, depending on the segment you operate. For example, we operate in gems and jewelry space, as a bank with a reasonable space. There, it's a transaction-to-transaction monitoring that we adopt. And that's been our success point for that particular business. In vehicles, it's got a cross-guarantee model or a particular model. So each one of them has a different approach. Microfinance has got a different approach. So how you're able to adopt to that particular one, fine-tune technology, because you do different types of lending. And again, also, you need to have more information based on which rating category you take your people under. So you will monitor those with a weaker category far more often than what you will monitor those in a better rating category, unless there's an alert. Because otherwise, you'll only be monitoring a lot. You also have to continue to do your other things. So the monitoring part will become larger than everything else. So, Hemanth, are you there? Sorry.
Right. That is true.
Sorry, I lost you. So, if you can hear me. So basically, it's important to, there'll be a lot of information that's available. The critical part is you have to identify how you want to use that information, and what is the kind of structure in the organization where you filter that information and then take actions on it. Otherwise, you'll spend too much time. So, there's an overload of information. So your better rated names, you'll do it less frequently. Or your double B name or a single B name, or if you have any of those in your book, you'll monitor it more frequently. You will have your red alerts or whatever, your flags set accordingly, and you react differently. So you would, monitor a particular group every month, some maybe on quarterly. So I think it's very important to find the right balance. Otherwise, monitoring will overtake what you will do otherwise. And too much of monitoring may not give you, you have to find the ideal bang for your buck effectively on that monitoring, in my view. So today, a lot of offers come to us on a lot of things. You have to be very clear what we can do. There's some are regulatory and some are need-based. So the regulator has, defined all of these criteria. As you know, there are 48, 50 criteria that you have to track data-wise. There are softer points, etc. They want us to automate a lot of things. So that has to be done because that's regulatory. There are some other things that we want ourselves, but beyond that, you'll have to be sure whether you want to add on much more to it. Because otherwise, a lot of time will be spent on just sorting out those, alerts that keep coming up.
Right. So I think I think there's one audience question that we can kind of take now. So the question is, how do you achieve granular level control on your customers? That's the question. So I'm guessing the intent is to see not to what level of detail can evaluate the customer and how to monitor them with a lot of granularity. Any thoughts there?
It depends. As I said, so it's a large corporate, you're not going to get to be able to monitor them on a granular basis.
Right.
In a mid-market MSME where you're sole banking, you have a better opportunity to do that because you'll get all the flows through yourself. So as I said, depends on the type of client and thing. There are certain things like credit cards. Obviously, every month you get data. You have data spends. You have the kind of spends the person does. How much roll rates are there? How much is the interest? So that's a different. You don't categorize. Loan against property is a one area where the property valuation becomes more critical with the cash flows. So that's all you can do because you cannot really do much monitoring there. MSME, obviously, as a business, you can. So as I said, that each MFI, a borrower, it's a 6-month loan. So you cannot do much more than ensure that they come to meetings and they pay you, because you cannot monitor much because you won't get data on a rural what they do. So are they attending meetings? Are they skipping meetings? That is what you can do. So there are different types of monitoring on the granularity you want to achieve. So a large corporate will be a once a year kind of thing that you get an update. You look at the borrowing and everything else, or if there's any major development which you pick up through your monitoring system. So it depends upon the type of customer and the type of business you do. While for a gems and jewelry customer of ours, the monitoring is daily. It's literally on a daily basis. Every bill is tracked through the system, because that's the way we think we can do the business. And that's why we have, we've had a good run with that. Or vehicle finance on the cost guarantee models. Who are the guarantors? What is their track record of payment? There may be delays, but we understand this borrower pays ultimately. A lot of data that goes into understanding that. So we may not push him at the end of 30 days for a collection, but we know we have to, this customer is on the 60-day bucket. So the granularity depends upon the type of customer and the type of business that we do. So some may require daily monitoring, like the general way. Some may require more infrequent monitoring.
Sure. So, two things that I want to highlight in terms of what Crediwatch does or enables in the space as well, right? One is even when we're talking about the larger entities, listed or otherwise, in terms of the kind of information that is available in the public domain, sometimes kind of gets overwhelming, right? You either don't know all the sources from where you could get useful information to kind of monitor the entity. And second is it becomes very difficult to kind of track all of these hundreds of sources of regulatory data itself, for example, that exists, right? Whether it's EPFO, GST, the courts systems where anything adverse might be running in terms of a case, the plethora of news media and the coverage that is there in news media itself. We spoke about the alternative data in terms of EPFO, other taxation systems, the regulatory filings that they make, etc. Right. So one of the things that we kind of help financial institutions and banks kind of do is provide sort of a singular view about all of these different data sources and data points, right? So then it becomes sort of a single window where you can take a look at all the different information pieces that exist about the customer, and some of them kind of translate into alerts automatically on the system as well, right? So there you have control on what kind of data points you want to use for maybe what segments of customers, and what is relevant for which segment of your own borrower, right? That is one. The other aspect that we've also seen a lot of traction is this entire consent framework that's sort of emerging, right? Whether it's through the account aggregator kind of framework, or even otherwise with the consent of the end user, the information that you can now subscribe to, right? It could be his bank statement, it could be his tax records, it could even be his audited financial statements from the auditor itself. And what we kind of help do there is also look at all of these different data points and kind of present whether these are coherent, right? Like, for example, a GST statement, if you take a 12-month view of the GST returns that he has filed, and then you look at either the income tax returns or even the bank statement, right? They should all kind of be narrating the same story, right? And that, in essence, kind of gives you the confidence that the business is actually sort of genuine and reporting all data that is to report, right? And I think with the advent of this entire consent-driven mechanism itself, I think you now have a lot more data points that you could sort of take a look at and take both credit as well as monitoring decisions itself, right? And this, we've seen a lot of interest from the ecosystem itself when it comes to this consent-driven data and how it can get used. There are, of course, operational challenges. I username, passwords are forgotten. The OTP goes to some CA or an auditor, and it's kind of difficult to access. But I think these will settle down over a period of time, and the use of this consent-driven data also, I think, is going to add a lot more meat into the analysis itself, right?
Yeah, you're right.
So moving on, I think. Sorry,
No, just wanted to add here that the critical part is I think RBI is also trying to come up with a common data platform, where they like the aggregator to provide data. So they're working on, I think it was Dr. Viral Acharya's idea, and it was being worked on. So I'm not sure when that will get launched. Second, I think the important part is we will get a lot of this data. We'll have to internally build skill sets on behavioral study or analysis of this, so that we will be able to, be able to do what we call understand what the trends are and then work on it. Otherwise, you'll be reacting for everything. So you'll have to also have a good set of people internally who understand and call out and see that this is the behavioral pattern. So it's okay, this customer, and this is a customer I need to worry about. So it may not be the same for every bank. It depends on the different types of businesses. So I think that's the critical part.
Right. And one of the points that you also mentioned about the regulatory policies itself that are sort of emerging and evolving on a sort of a day-to-day kind of basis, right? How do you sort of keep up with these regulatory requirements and changes itself, right? One, of course, the reporting side, which could be a lot more dynamic, that the regulator might on one fine day say, kind of give me your historical data and what you reported there, and how did that impact the business itself. The other, of course, is also on changing policies, right? And one of the key things to do is to sort of keep both the bank's policies and the regulatory policies aligned at all points in time. So from a credit monitoring perspective, how do you kind of keep up to date and keep up with the regulator itself?
Yeah. So regulatory, we rely a lot on two teams in the bank. One is our compliance team, which is constantly, gets all the regulations which are published, and it disseminates to the different people who have to react to it. So payments kind of thing will go to our operations team. Risk related will come into our team, and then there is no doubt within the CRO vertical a team which is dedicated to looking to ensure that policies are up to date. But that is challenging. The number of regulations that are getting issued are quite a few even during this time. Every month there has been a material regulation that's been issued. So there has been one on the change in the LFAR, the long form audit report requirements for auditors. There was one on short-term reviews, annual reviews. There has been one on, during COVID itself, there have been policies on COVID restructuring method, whatever has to be done, or the moratorium. So it's quite significant effort. So it's concentrated. We've kind of got around doing that, but some of the requirements are so much in black and white that you say you have to do a review annually for this. It's written somewhere there. How do we track that? How do we, institutionalize that? If you're on a manual approval process, that becomes very difficult. So we have now made our systems robust enough to ensure all of it is captured. For example, if you do lendings to investment trust or REITs, you're supposed to do every 6 months a review with the audit committee of the board. Is one of the regulations. So you have to keep up with that. So these are things that we have to now keep close track of, because otherwise become regulatory violations. So it's challenging, but banks, we are quite equipped with the compliance function and specialized risk teams to look at it, that we manage that part of it reasonably well. But capturing all the data, because any form of data cut is asked, is the critical part today. So you could be asked how many customers did you extend the tenor by X or Y, and your data, you should be able to query it and get it, not have to manually work on it, because the time given to you to respond is less. So we're slowly adopting to that by capturing as much even if you think it's relevant today, may become relevant later. So we capture all the data points so that you can use that data field to pull out the data later. So it is tough, and the regulations come every time there's a major issue in the market on a bank or a NBFC or something, there are new regulations that hit you. So, and the regulator is looking very closely at the compliance function, the risk function, the audit function, as the three critical functions to look at, and look at the bank's overall systems and processes, and they expect a lot to be done. They expect all three to coordinate and work very closely to keep the bank safe. So to that extent, a lot of automation is required, and a lot of information exchange is required with internally as well as externally. And that's leading to a lot of data capture. And as I said about using our cloud and data marts and others for getting all of this done. So regulatory demands are very high. So I think you need to be right on top of it by keeping up with the data. And that's the way they're going to monitor. Monitoring used to be a few years ago on an annual inspection. Now it's on a nearly daily basis. If tomorrow morning there is one NBFC goes into trouble, by 11 o'clock, I can be sure that if in the morning newspaper said by 11, there will be a message from the Reserve Bank, each of the banks asking us for our exposure data as of that day. So that's how it's changed today, because there are dedicated teams. There are very good risk analytics in RBI themselves. They send us message saying this industry classification is wrong in your bank when we compare with others. So they have built up a very strong data analytics team, and they compare and cross-verify. So you have to be a one-up if you have to be able to answer to all of
that. Right. And how has the bank's adoption of AI and ML itself changed over the years, right? Especially now where a lot of AI and ML is kind of getting mainstream. How do you see that itself evolve and sort of make it a part and parcel of the bank itself?
Yeah, a lot of that. I mean, in your mobile banking, you have a chatbot which talks to your customer and answers, which was the simpler ones. We've used a lot of robotics in our standard operating things in our trade shop or whatever. So machine learning is critical. For example, in stock statements, I was talking about, scan your stock statement and it can calculate your drawing part. Machine learns to ask queries if there's a 20%, 20%. So we've worked with fintech companies on doing that. So more and more I hear of these words being used. It's a challenge because I'm not tech savvy, so I'm dependent on others to so working a lot closely with our technology team or a solution delivery team, understanding what it is, or giving the idea and they help you convert it. So you really I increasingly feel the need of having my own a kind of a data scientist, or whatever you call a technology specialist within the risk vertical. So it's easier to talk and they become specialized. That's what I'm discussing, to get rather than depend on a technology team. I want somebody who's within my vertical. So we created a solution delivery group for risk office, which has helped us do a lot of stuff. But I feel we need to step up on that. And I think it's becoming more and more important so that you're up to date and you learn about it and you start using those things better, so that routine stuff gets done automatically. You don't have to worry about it being missed out. These things will, which was the repetition can get done. You don't have to remember it. It will just get done. And every morning, for example, we have that brought everybody, identified list. This is your customers who are owed you. Earlier, it used to take till the end of the day for us to Excel, manipulate, massage the data, send it out. Now, it comes out earlier in the day. Or 2, 3 days. Now it's done within a day. So all of this is slowly getting adopted, but more and more of that is happening, and it will happen faster now post these COVID times and us wanting to be more productive and efficient.
Okay, and you also indicated that you're sort of a avid reader. Any recent books that you would want to kind of mention to the audience, given the topic itself that you're covering?
Interesting. This is something when I went looking at a college for my son, there was in their library they had a section called failed corporations. So it was a section full of books on only companies that failed, and I thought that's quite relevant as a risk guy to read about companies that have failed. And I've also had my own experiences of being part of decisions of companies that have failed. So recently, a couple of them, I think there's one by Kamal Bandyopadhyay, which was, I think, the Great Indian Banking Pandemonium. That was interesting.
Right.
There had a lot of stuff written there. Never Too Big to Fail on IL&FS was a book written by an insider, which also I kind of managed to finish reading the last few days. It gives you different types of insights about how that organization grew and how all signs were known, but things still went bad. So continue to read that, continue to keep up with these kind of articles and books to know what went bad. At least that will help you to hopefully avoid such mistakes when you take decisions, or bring it up in discussion so that people So if you cannot stay up ahead of the curve, or because in banking, as you'll notice over a period of time, the same things happen. Memories are short, so you will end up with a scamster you will finance after 6 years, 8 years, because it's been forgotten that this was what happened about 8 or 10 years ago. So that memory sometimes is the risk guys is institutionalized the head, and you have to keep remembering all of that. And if you, I enjoy, do a bit of reading, but this kind of reading helps me to at least keep up with what's happening. It's more topical to what I do day to day, but it also keeps me on my toes to understand what could go wrong or what went wrong. And we also do internally are developing our own case studies on experiences we've had in the last 3 years, which we want to institutionalize so that with no name basis, so that the future analysts, RMs who come in will all be asked to go through it and take a set of questions, because that will be a good way to institutionalize a memory. We've had every bank has its own challenges and problems that it's had on accounts, and it's best to bring it down so that people don't forget about it and they track it in future. So it's something that I'm working on. Hopefully we'll get some of these case studies out in the next 3 months, and we'll ensure that everybody take a set of people will be compulsory to do it, and I think you're required to get 8 or 9 out of 10 query questions, right? It's a compulsory training there.
All right, thank you for that. I think we can just maybe take a couple of more questions that have come in now, and then we can call it a wrap. So one of the questions, and this is from Manish, is so in recent years, the financial crime has increasingly become a bit of a concern, both for governments as well as financial institutions. What's your view on combating organized crimes with the help of evolved technology, and how can we integrate with other players in the market to prevent this from happening? More on the financial fraud angle using technology.
Yeah, it's quite challenging actually. Trying to look at this part. In recent times, the number of queries that banks are getting from agencies on the fraud part of it, because you're talking about SFIO, ED, etc., EOW. You don't want to get into a fraud case because you have to store the data. You have to do it. So we've learned a lot of stuff in that area. But how to do it, it needs a different mindset. Maybe I think we need to go out and hire people who have got that kind of I've read about that, places like multinational banks have actually hired from, in the US, hired from, the FBI and other kind of institutions, so we have not got there, but maybe that's what we really need to do, because traditional banking may not help. So we'll have to go and find such technical experts or ethical hackers, as you call, to come and, try to tell you this is what could go wrong. And we do that. We work with ethical hackers and also test our systems. But our security team is working on that, but it needs to evolve quite a lot. But the other challenge on financial crime and other data is also to capture and maintain all your data for years together, because the investigations and others go on for long. So as bankers, today we have to expect to keep that data. A lot of this electronic data, so we need backups. We need to keep them for a very long time, because a relationship manager or somebody could have moved on, but the investigation may come 7 years later. So that's also becoming something that we're seeing. So we have learned to keep a lot of that data stored and available for future reference. So sorry.
Sure. Yeah.
So yeah, I think it needs a different skill set, and we'll have to work towards that. Today, it's more of the chief information security officer and IT looking at it, but maybe as it gets more sophisticated, we'll have to hire specialists to look at it. And we haven't yet done that in our bank, but I guess we will ultimately have to do it, I guess.
And I think in this context, one question from Anup Agarwal as well. What role does a forensic auditor or an internal auditor itself play at the bank? How do you
So we have, there was a Malagam committee recommendation which we adopted, and we have built up a skill set. So we are working with some of these special agencies on both technology-driven as well as the forensic part. Because forensic audits, we could use external agencies, which we do wherever there have been frauds. Wherever there's a fraud case which we identify or a diversion of funds, we have a forensic auditor. That's a requirement anyway by RBI under their own guidelines on stressed accounts and others. So forensic audits are done, but internally also we are developing that skill set by hiring people so that we can do this for smaller accounts. They are more of the investigative type than being pure auditors of the accounting type, and they are going out and checking stock statements or not stock statements, checking the stock or diversion and etc. accounts using other agencies to help. So that's becoming an important part. This guidelines came last year, so the board adopted it from April. It's under a colleague of mine who's working on it. We took it out of the normal internal audit process, kept it separate, and he's putting in people together who have got that. And we're also using an external firm to advise us on the way to go about it. So hopefully it'll get in place in a few months, and then we will be able to do our own audits without relying on external agencies. For certain value accounts, larger value accounts, we'll have to, where it involves multiple, we'll have to go to bigger firms, maybe the Big Four or the likes of Alvarez, Marshall, and others who are the ones who do this.
Right. I think there are a few other questions that we will need to kind of take up offline. We will sort of collate all the answers for the unanswered questions and respond on those specific questions itself. For the conversation itself, thank you so much, Ramu, for taking the time out and participating on this chat. We could have gone on for a few more hours for sure, but given the kind of paucity of time, I think we will kind of have the fireside chat itself conclude at the moment. One of the things that I want to kind of leave with the audience is have a quick walkthrough of the Crediwatch system and the EWS or the monitoring system itself that Crediwatch deploys. And this is currently also being used at the bank itself at IndusInd. Just a quick walkthrough on the capabilities that Crediwatch deploys and the solution that Crediwatch deploys. Just a quick walkthrough of
Thanks, man.
Right. So just a quick walkthrough about the Crediwatch solution, the monitoring system, and the solution that Crediwatch has. So the key difference that Crediwatch approaches to monitoring with is we've got a deep coverage, about 18 million entities, business entities that we cover in the country. And there's regulatory compliance. It's a zero human touch system. Essentially, a lot of this is sort of automated, and the idea is
we all can see in full screen. Please go ahead. Thank you.
All right. The system is scalable. It comes with a low cost because we can use cloud deployment and cloud technologies. Singularity of insights, configurable workflows, and API ready. Essentially, this becomes a critical aspect when you want to combine the data and insights that Crediwatch serves with your own internal systems, right? The other thing is we have 100% coverage in terms of both the RBI and the DFS guidelines on early warning systems. And our solutions cover over 170 public data-driven EWS signals and 80 plus EWS signals based on private data that the financial institution can share with us, and using our ML base and the signal library itself that we have, we can sort of continuously monitor the internal data sources to generate these alerts as well, right? And the benefit of the tools that we provide itself is one, of course, it's a web-based monitoring solution. So it comes off the shelf with a browser-enabled platform that you can kind of use without having to install any custom software. There's email alerts that the system triggers. So on-the-go emails that you can receive, and you can help monitor your own portfolios through the email alerts. There's a risk scorecard. Again, this is sort of an ML driven model that we have, a lot of backtested data on using which we're able to offer a risk classification itself on the entire portfolio. And of course, there's a wide coverage of data points, over 2,500 plus data points that we monitor from both the public as well as the private domains, right? So it also has sort of an administrative dashboard, a lot of configurations that you can do as a end user, download of these reports and data formats. All of this comes off the shelf. Of course, there's the element of customization also that's possible using the platform. The customer master, all the centralized information around your customers, the historic data of their alerts and triggers, and data integration, of course, with the bank's underlying systems. These could be your OCR systems that might exist, or a core banking system, an LMS system, or a LOS system itself. So all of these integrations and connectivities also something that's possible, right? And the view that we take in terms of monitoring is we take three pillars of data and sort of enable monitoring across these three pillars. You have the public data, which is data that's accessible in the public domain. These could be paid data sources as well as free data sources, but essentially something that's accessible by the public. There's also private data, data about the business with the bank and with the financial institution. And then, of course, consent-driven data as well. Right. This is sort of a typical portfolio level view that Crediwatch helps you take a look at. So there are 15 different public data driven parameters that we track, and we kind of risk classify them on each parameter. And then there's an overall account level or a borrower level risk classification itself that we do, right? So this kind of gives you a very quick insight into how your portfolio is performing, what are the risks that are associated with the portfolio, what are some of the specific borrowers that might need a keener watch or an eye on, right? And there are also alerts that the system generates, and these alerts are typically generated on a daily basis. It kind of monitors your portfolio 24/7, and you're able to kind of take a look at different data points, right? And these are some of the dashboards itself at a company level, which gives you sort of a drill down or an insight into how the individual borrower is performing. We track 15 different parameters from a public data point of view, and about 15 to 18 parameters even on the private data or the account conduct data. And all of this is kind of risk classified and set up as an end-to-end monitoring, right? And the entire process of monitoring is automated. So that kind of gives you the ability to scale. We monitor as many as even 10,000 accounts at a particular financial institution itself. And this kind of gives you sort of a real good grip or a grasp about, who are the key borrowers which might need a lot more attention and focus on, right? And similarly, when we integrate with the bank's internal systems, we are also able to generate a scorecard based on the private data or account conduct data itself. And then we kind of present a fused view where you can look at both public as well as private data points to be able to assess the borrower and evaluate the risk with the borrower itself. Right, and similar views on the private data side as well. We can sort of give you drill downs and cuts about the different data points from the private data perspective as well. This is a sample of an emailer. We have daily email notifications meant for typically the relationship managers who would want to track these companies at a most granular level. We also have sort of summarized fortnightly mailers which are more for sort of the managers and the overall risk teams itself, who get a bird's eye view about what's happening in the portfolio and what transpired or what changed in the fortnightly period. Right, and we also have a case management workflow system that is integrated with the monitoring solution. So the case management typically is what RMs will use to reach out to their customers, understand the cause behind some of these alerts, verify them, come back with data points and substantiations, and report them back on the workflow. Right. So this kind of helps manage the end-to-end workflow from the triggering of an alert to its eventual resolution and customer follow-up as well. Right, and all of this is sort of off the shelf, but we can kind of set it up within a matter of a few weeks in any financial institution. So these are some of our customers where one or more of the Crediwatch product suite itself is sort of deployed and is currently being used. And then there's a whole suite of products that Crediwatch has. Monitoring solution is one of them, but we have different products that cater to the entire credit life cycle itself. These are some awards and recognitions that we have won, and that kind of gives us the validation and the confidence about the product being adopted in the market and bringing about a difference the way people run business. Right? This is the team, a team of cross-functional expertise, from lawyers to bankers to technology specialists to UI experts, and the team kind of puts together the entire suite of products itself. There's more information. You can always reach out to us. We'll be kind of glad to come back and connect with you, understand your requirements more, and hopefully we kind of connect again to offer the solutions itself. There's a small follow-up poll that will show up on the screens now, so you could kind of indicate your feedback here. We are always happy to take questions. You can reach out to us even outside the current webinar itself. We'll be happy to get in touch with you and address any questions that you might have. Thank you so much for participating in this webinar itself, and special thanks again to Ram for taking the time out of his busy schedule and participating in this fireside chat. Look forward to interacting with many of you again, and look forward to more series here. Thanks to CII and thanks to Abhishek as well for coordinating and putting this together. We'll be happy to address some of the questions that we could not answer. We will, of course, answer them and come back to you subsequently. Over to you, Abhishek.
Sure. Thank you so much, everybody. Thank you so much, all the participants to attend today's session. We keep on coming with such kind of informative sessions with Crediwatch. Thank you so much, Hemanth. Thank you so much, Mr. Ramaswamy, for sharing such an insightful details around your expertise. And thank you so much, everybody. We please do maintain the social distancing and stay safe. Thank you.